Hello traders, Gary Wagner here. It is 11:50 in Honolulu, 5:50 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the second day of August, 2024, and this is the evening report for gold and silver, our weekend review. Gold had a tremendous week with strong upside moves at the beginning of the week. However, today we saw increased volatility as seen through the range, but a very little net change to December gold. December gold lost $4.80 and is currently fixed at $2,486.10. However, I draw your attention to the range today in which gold traded to a high of $2,522.50 and a low of $2,453.10, an exceedingly volatile day due to the release of today's jobs report. Silver had a much quieter day, closing down 0.30%. That's a net decline of 8.5 cents, taking the most active September contract to $28.39. But traders, it was the dollar today that garnered a lot of attention, giving up 1.09%, taking the index to 103. That significant drop truly tempered any of the price declines in gold or silver. Traders, before I cover our forecast for gold next week, I want to cover trades that we did this week. We recommended 2 trades, one today and one earlier this week. This morning, we did send out a trade alert to buy December gold on a limit at $24.91, placing a stop at $24.85. After the release of the jobs report, gold literally fell out of bed, and although it did recover, it did fill our order at $24.91 and hit our stop at $24.85, resulting in a loss of $600 per COMEX contract. The other trade that we did occurred earlier in the week when we positioned ourselves long prior to the conclusion of this week's FOMC meeting. We sent out a market order to go long December gold. That was trading at $2,429, so we entered here. Initially, we put our stop right at $24.18 and raised it as gold prices began to trade higher. The last price point that we raised our stop to was $24.91, and when gold began to retrace and come down, we effectively were stopped out. We went long at $24.29. We got out at $24.91 for a profit of $6,200 per COMEX contract. As to our forecast for gold, we are looking at a 4-hour standard candlestick chart of gold. And on today's show, I want to look at what we call the subcount, the fractal nature behind our Elliott wave count. We will begin with the correction after gold traded to a record high on the 19th day of May and began a correction. One way to look at the count would be to be a simple A, B, and C, concluding our correction and then restarting our impulse phase with a wave 1 and wave 2, which takes us to our current assessment, which is that we have begun our third impulse wave, which will then be divided into 5 intermediate waves below the primary count. The primary is the full third wave. The subcount behind it is what we're labeling intermediate, and we have probably completed our 1 of 5 and possibly even our 2 of 5, making up this third wave. Next week we'll begin our 3 of 5, and what we will begin to do is calculate where we believe wave 3 could go by using our wave 1 as our benchmark wave and then doing a Fibonacci extension to show the different levels. That will guide us in terms of our strategy next week. This has been Gary Wagner wishing you, as always, good trading. Have a great weekend. We will talk to you next week. Bye-bye.